Morning, everybody. My name is Rimal Qureshi. We would like to welcome you today to our event, which is Introduction to Short Selling. The program today is sponsored by the Financial Academy, and the contributing partner is the Saudi exchange Tadawul. Financial Academy has a role in the industry, which is to close the financial gap which exists in the financial sector through providing education services like exams, training courses, and the webinars, just like these ones. This program is also prepared and presented by the company Zishi. Now I would like to introduce Mr. Jeff Haim from Zishi to take over and introduce the speaker. The program is about 2 hours, so please stay close. And if you have any questions, please do add them in the chat. Mr. Jeff?
Thanks very much, Reem. Good morning, everybody. Welcome to this session. We are delighted to be able to present this webinar on short selling with our friends and partners at the Financial Academy and Tadawul. We are planning a very interactive, very interesting session. We are lucky to have Mr. Russell Hammerson, who is one of our foremost experts in the field of financial products, who works with our clients globally on all aspects of financial markets training. So we have a great session planned for you. I hope you're going to get a lot out of it. And at this point, I'll hand over to Russell and we can get the session started.
Thank you, Reem. Thank you, Jeff, and welcome and good morning. As you just heard, it's going to be about a 2-hour session, but before I introduce myself, don't worry. What we're going to do is, after about 45 minutes, we'll have a coffee break. So 10 minutes so you can stretch your legs. So as you just heard, my name is Russell Hammerson, and who am I? Well, I've spent about 19 years in the financial markets on the trading side, covering most of the asset classes from fixed income, equities, and commodities and currencies. But today we're going to be focusing on short selling. So let's get going. If you have any questions, please, by all means, put them on the chat. And what might be appropriate is during the break, I'll have a look at the chat and I'll try and respond to the questions just after the break. And then, of course, at the end, we'll have a Q&A session. So let's think about short selling. What we're going to start off with, though, we're going to break this down into essentially 3 sections. So we're going to think about what is short selling all about. And then once we've understood the concept of short selling, we're going to think about the mechanics, what you need to do, what you can't do, and what you should be aware of. And then we're going to think about why are we short selling? What are the triggers, the signals that will alert us to those opportunities? And then also, it's not just the profit that you can make. You've also got to think about the downside. So we're also going to think about what can possibly go wrong, the risks. So we'll look at the P&L and the risks. First of all, let's think about going long and going short. If you're comfortable with going long, then it's not too difficult to appreciate the other side, the short position, because the short position is nothing more than the opposite of a long position. Naturally, if you're going to go long an asset, you have the expectation that the underlying asset, the equities, the share price is going to rise. Of course, there are those investors, speculators, players in the market that don't necessarily believe that the price is right. A price might be trading too high. There's too much momentum. There's a bubble around that stock or indeed that market. If you think it's overpriced, you're expecting the market to go down, and why not short it? All right, but let's look a little deeper than that. If you feel comfortable with going long, buying a stock, you believe the share price is going up, and let's illustrate this. Let's say you buy a share and it's trading at 40 SARs. If the price rises, let's say in this instance, it's going up from 40 to 54. If you then sell, you're making 40 SARs per share. Well, that's very simple to appreciate. The short sell, being the opposite, is equally simple to appreciate. You believe it's overpriced, you believe the share or the price is going down, and you're going to short it. Now, you will notice here that you're going to short this company, and I've got here, you're selling 1,000 shares, and you have to borrow these shares. And I'll come back to that in a quick question. So this is what we call, in a quick moment, this is what we call a covered short. So you sell the shares. As you sell the shares, you need to borrow the shares. The price, let's say, goes down. So we have an initial price of 58 SARs. The price falls, it hits your target, and you want to lock in that fall in price. That's your P&L. So to close the trade, you need to buy back those 1,000 shares, all right? And let's say the price goes from 58 to 42. As you buy back those shares, you close out the trade, and you've locked in your 16 SARs per share. So, building on that, when is an appropriate time to short? We're going to spend a little bit more time on that towards the latter part of this webinar, but let's just have a look at this, this price history here. What I have here is the price track over a period of time, and we can see that there's an upward momentum here, and that's basically being illustrated through this top and this bottom channel. And of course, prices don't move continuously up or continuously down. So what we see at this point here is we got higher lows. And as we hit this bottom channel here, we then see the upward momentum returning again. But there's a point at which momentum is going to run out. And what we can see is at this point, with the benefit of hindsight, that it now peaks here. It doesn't break through this channel at this point here. So this is where traders might be scalping the market. The traders might have come in at this point here and bought low. It then reaches around 54 SARs. And then you think, right, okay, it's not going for the breakout. It's therefore in a momentum, but it's not continuously upward momentum. This might be the opportunity to short. And as you can see, if it's shorted here at around 55 SARs, it then falls in a relatively quick period down to around 49 SARs. So one of the tools that shorters will use, in addition to the fundamental analysis, will be technical analysis. The fundamental analysis is going to essentially alert us to those opportunities. Is something overpriced? Is something trading in a bubble? But then the technical analysis will, as an additional tool, help us to identify when is the most appropriate time. So a lot of shorters will not just exclusively rely on fundamental. They'll use technical analysis as an overlay to assist them to get the timing right. And we can see this general pattern over a period of time being repeated as it hits the bottom and then the top channel. So if we're comfortable with going long, remember, shorting, taking a short position, is the opposite. You should feel comfortable with shorting as well. But there's some other things that we need to consider when you short. And this is illustrated in this little bubble up here. Hold on. If I don't own the stock in the first place, then how can I sell something I don't own? And this is the point. If I short something, I then have to, I've sold something, I then have to deliver that stock at the appropriate settlement date at T+2. So to facilitate the short sale, I am going to have to borrow the underlying stock from my broker such that I can deliver at the pre-required settlement date, let's say T+2. I borrow the stock and then I deliver to the exchange that stock so it can settle. All right, this is what we call a covered short. And certainly in most financial markets, and indeed in the Saudi market, you will not be permitted to short unless it's what we call a covered short selling program. All right. In other words, just to make sure that we're all on board, you have to, prior or at execution, facilitate the borrowing of the stock, and then you can short sell that underlying equity. All right. Naked shorts will not be permitted in Saudi, and indeed are not permitted in the US or Europe. So again, I stress, you need to facilitate the short selling by borrowing a stock first, the same stock that you're short selling. And maybe an illustration here is easier. So we've done our fundamental analysis. Let's say we believe the stock is overpriced. It's trading far above maybe its fair or its intrinsic value. So points 2 and points 3. If this is a target to short sell, remember, I have to, at the same time or prior to execution, facilitate the stock borrow. So I'm going to borrow the stock and I'm going to simultaneously sell the stock. The stock is trading at 50 SARS. Now, at some point, let's say the stock price goes down and it continues to go down. Hopefully we have a closeout price in mind. And let's say in this illustration, we believe that the fair value is 40 ZARs. So as the stock price goes down, it hits our target of 40. We want to take the profit out of the trade, the 10 SARs per share. To do this, to close out this trade, reverse it, terminate it, whichever expression you wish to use, we need to buy back those shares. We buy back those shares and then we return the stock that we borrowed to the broker, and the broker will then pass that on to the beneficial owner, the original owner. In this case, we have banked a profit of 10 SARs per share. Of course, there's costs associated with this, and we're going to talk about that very, very shortly. So why do we use it? Well, we've already discussed that perhaps it's a way to express a view about a company. You think a company is overvalued. Maybe it's also about point 2. I want to balance my investments. I might have taken a short position, and now I think it's fairly valued as the price has come down, and then I'll switch to a long position, as we saw in that price channel. Also, we see shorting, not just on the side where I believe that something is overvalued and I'm going to take directional market risk. Shorting is full directional risk in the same way as when you go long, you're taking directional risk. What I might want is a market neutral strategy. In other words, an outperformance trade. So I can combine a long and a short, and I am expecting one of these assets to outperform the other, and on a short on correlated or closely related entities, I've therefore removed a vast proportion of the directional risk. I could be just managing my portfolio. I'm a long holder, and I want to reduce my risk. I don't have to reduce it fully. I might want to put on a 10%, a 20% hedge against the uncertain times. Also, it's a natural position for a market maker. Market makers are continuously, offering liquidity and flow to the market. And what they will, in many instances, be is short the underlying stock. So they will need to borrow the stock to cover that. And of course, there are other trades. I might be thinking about different parts of the capital structure. So if I look at hybrids, for example, hybrid bonds like convertible bonds, I might be in that convertible bond more for the optionality than exposure to the share price. So I will use shorts to hedge out the market risk, the exposure of that share in the bond, while I'm just looking to take exposure to the volatility and the optionality. So there's many reasons why we might want to use these short sales. Now, we will be talking to a broker when we go long, and the same when we go short. And don't forget that the broker must facilitate that short on your behalf, right? Now, we don't win on every trade, yeah? It would be great if we could, but it is very unlikely that every trade is a winner. So please be aware that if the shares are trading at a higher price than when you originally sold them at, you will have a loss, all right? Now, we're going to talk about some of the risks behind it shortly, but at the higher the price goes, it's going against you. And there will be a point in time, perhaps, when you will be forced to close out this trade, because there might be a short squeeze. More on this later. But what might happen is the share price starts to rise and then shoots up, it rockets. And this is the other participants in the market that are squeezing you. Yeah, as the price rises and continues to rise, your profits have been squeezed, and indeed, it's more than likely you're now losing money. Now, if you're losing money, then somebody else is at risk, right? So you will need to collateralize these trades. There is full collateralization, and I'll explain that graphically. It's easier to see how that works. And of course, as each day goes by, and as each day the mark to market, the move in the share price rises, goes against you, you will need to put up an increasing amount of margin to cover those losses. So short sales require first of all, for you to borrow the shares, and then you'll need to put up collateral, cash and or securities, equivalent to at least 100% of the value of that transaction. So where does the cash come from? Well, if you've shorted something, you've sold something, therefore you will have that cash coming in from the sale of that share. That cash is used as collateral. If the share price goes down after you've transacted, then you will have in your account a positive mark to market. But as the share price rises and rises above your sale price, you will need to cover that risk exposure fully on a one-to-one basis. For example, you've sold at 50 SARS. If the following day the share price then moves up to 60, you will have to put in 10 SARS for every share that you sold as an increase in your margin account. This will be facilitated by the broker. So we've said we have to borrow these shares. Now, there's a relationship between you, the broker and the market and the lender, the original lender of those shares. Now, the lender isn't going to lend you these shares for nothing. There will be a fee. We'll talk about that fee shortly. And when the lender lends the shares to the shorter, they want to ensure that they keep throughout that loan period all of the economic benefits, right, of holding. And of course, one of the major economic benefits is any cash flow, the dividends. So the shorter is responsible for delivering any dividends that are paid throughout that transaction period back to the lender, because they're retaining the full economic benefits. But point two, they have lent the shorter, the borrower, the securities, those shares, and the title, the ownership, the legal title will flow from the lender to the borrower. All right. So now the shorter is in control of the voting rights. Okay. Now the lender might not be too happy about that and might want to vote. So essentially, and this is dependent upon the terms that you trade, but typically the lender will lend you the shares, but will have a daily recall to get the shares back from the borrower because they might want to exercise any voting rights. If you still require those shares as a shorter, you will be obliged to return those shares you borrowed. But you can go back into the lending market and borrow those shares again. All right. But if everybody else is borrowing them, maybe because there's a lot of shorting going on, or there isn't sufficient free float, then you might find that the borrowing costs will start to escalate. You've sold the shares. You've got the cash from the sale of those shares, and then that cash provides the collateral for the risk exposure for the counterparty on the other side. Now, you will also need to pay a fee to the lender, and that fee is coming out of the yield that is accruing on this collateral. I'm going to stress it again. There will be a daily mark to market. So that collateral is effectively your initial margin. As the market goes against you, as the price rises, you will need to top up on a daily basis any losses. So there will be a variation margin. We've said this point already. Number 5, you will have to, as we call it, manufacture the dividends. You'll have to pass on any dividends throughout that transaction period that you have collected back to the original owner, the lender. Remember, the lender gives up the voting rights because you, as the borrower, are now the legal owner until you return those shares. So don't forget, the lender has the right to recall. And this is the point at the bottom here, a daily recall. And of course, this will all be specified in the agreement with the broker. All right. Now, you can return those shares at any time. This is point 7. Again, this will be agreed in each and every document that you have, legal agreement. So you're never quite sure how long this transaction is going to occur. When it hits your target, you're selling at, let's say, 50 SARS, your target might be 35 SARS. You don't know how long that's going to take. So you have the right to borrow the shares for as long as you wish, unless there has been a daily recall from the original lender. Let's have a look at the bigger picture. So we have on the far right, we have our shorter. It could be a flow trader, a speculator, it could be an investment fund, a hedge fund. It could be a private individual. They have identified a target. They will need, when they talk to their broker, to specify that it's a short sale. Why is that? Because the broker will need to facilitate the stock borrow. So the broker will go into the marketplace and borrow this stock, source this stock. Where do they get it from? Well, there's lending agents out there, there's custodians, there's a whole marketplace that is there for the lending and borrowing of stock. So this is a marketplace. They will source these securities and hold them in an account on your behalf. You will have to pay the collateral. Remember, you've shorted, so the collateral is coming from the shorting. And that will typically be at least 100% of the transaction value. Now, these, these securities, these shares, they could be dividends or indeed corporate actions. And that will be reflected, any changes, any cash flows, any changes in the capital structure will be reflected in the transaction that you're doing. There will be a mark to market on a daily basis. As the share price goes against you, as the share price rises, you will need to top up your margin. On the reverse, if the share price goes down, you'll have an increasing amount of cash in that margin account. There will also be a rebate or a fee. Effectively the same thing, but we'll talk about what the subtle difference is in a second. You are not borrowing this stock for nothing. So you will be paying the agent lender here, who's working on behalf of the original owner, we call them the beneficial owner, they will require a small fee. And of course, there will be a fee from the agent lender. Now, where does the agent lender get this stock from? It could be inventory in a broker's own account, or it can be sourced from the external marketplace, the typical long-only funds, the pension funds, insurance companies. They have a tremendous amount of capital that's invested in equities. So the two principles to the transaction are the beneficial owner, the lender, and the broker, who is effectively working on behalf of the shorter. So, stressing it again, the cash proceeds from the sale of the securities, those shares, will cover 100% of the collateral. All right. Now, you don't necessarily have to put up cash as collateral. You can put up securities or indeed other assets. But please note that whatever securities are put up as the collateral, the lower the quality of those securities and the higher the price volatility of the underlying stock that you've shorted, the greater the collateral requirement. All right. Now, in a second, we're going to talk about this fee or this rebate. If you're putting up cash as the collateral, we'll call it a rebate. If you're putting up securities or other assets, we'll call it a fee. Between you and me, it's exactly the same thing. But there's subtle legal differences. So let's have a look at the flow, the schematics, if we were putting up cash as collateral. So here on the right-hand side, the left-hand side, the green box, we have the shorter. They need to borrow the shares. They're going to borrow the shares from their broker, which might also be the agent lender. So they're going to get the shares. All right. Now, when they've short sold, they've got cash. And the cash is going to be sent to the broker sent to the agent via the broker, and will be held in a cash collateral account. Let's call it the investment account. Now, hopefully this cash is going to return some form of yield. There'll be interest. So the interest will be shared. The interest, and this is all pre-agreed, will flow to the agent lender. Now, the agent lender will pay the interest to the borrower less a rebate, i.e. a fee. So in other words, they are not getting 100% of the interest that's earned on this cash account. Just to give you an approximate idea, for those shares that are in the main headline index, lending shares can be anything from 25 to 50 basis points, and this is per annum. However, that is under normal market circumstances, because the lending market is a function primarily of supply and demand. So if everybody is borrowing or wanting to borrow those shares, that fee can rise significantly. It can rise to 1%, 2%, 3% per annum very easily. And in some instances can go considerably higher than that, 10, 20, 30, 50% or even more. If everybody is looking to short the same stock, then the availability of those shares to borrow is now very low. So the rebate, the fees will rise immeasurably under those instances. Now, the vast majority of the interest that is earned on this cash collateral will be kept by the borrower, and of course the lender wants their cut. So they will get a percentage of that fee. They'd call it the lending income. So what is the return for the agent? Why is the agent here? Well, they're facilitating, they're finding the stock, they're managing this process. So they're not doing it for free. So the agent's return is a function of X. This is the gross yield, the gross interest that's earned on this cash collateral, less the small fee, let's call it a fee, for the beneficial owner for lending out those securities, and of course Y, which is the major part of the interest that's earned, is going to go to the borrower, the shorter. So this is the flow when we're looking at cash collateral. But not all trades are necessarily collateralized with cash. If we have securities, it's fairly similar, but we still need to look at the subtle differences here. So the borrower gets the shares to cover that short. Those shares are then passed through T+2, trade date +2 days, to the stock exchange, so that short position can be settled. They are now putting up, the borrower puts up securities. These securities via the agent lender will be put into a non-cash collateral account, a securities account. All right. Now, there will be an upfront, not an upfront, sorry, a fee, a daily fee on this. It'll be basis points, a predefined basis point for each day. And that will be paid directly by the borrower. Daily recall, which means that each day, this fee will need to be rolled over at market prices. So if everybody's looking at shorting, everybody needs to then facilitate that short position by borrowing shares. If that's the case, it is very likely that this fee will start to rise and could rise considerably. So please be aware of that, because that fee is coming out of your total P&L at the end of the day. And then that fee will be passed on, not fully, after the agent takes their share, they will pass on Y. All right, a certain amount of pre-negotiated with the lender, a certain amount of fee. The P&L on these trades is quite simple. Essentially, what we look at is the purchase price. We're looking for the price to go down. And therefore, where we close out the price and the dividends. Remember, as a shorter, you don't have the rights to those dividends. So that is a cost to you, assuming that during the holding period, the transaction period, there are dividends paid. You have to pass them back to the original owner. And here I got an example where I'm putting up a margin, maybe 50% or 50% in this case. And that's likely because we're not putting up cash as collateral, we're putting up securities, and those securities might be a lower quality security and might also have a high volatility associated with it. So this is over collateralized. And let's look at an example. We've shorted 100 shares. If we've shorted 100 shares, we have to borrow 100 shares. And we've effected this trade at 50 SARs. And let's say throughout this period, there was a dividend that was paid. The dividend was 5% in terms of a yield, which is £250 SARs. Right, now we've sold short, we've borrowed the shares. To close out the trade, we now need to buy back those shares. The original price was 50 for 100 shares. So in this small example, the shorting proceeds are 5,000 SARs. Yeah. This will go into the margin account. But there's also something else that we need to take into account. During our holding period, dividends were paid. The dividend was 250 on 100 shares. So that's 250 SARs that will be deducted from your account. All right. Now we close out the trade. The share price has indeed gone down from 50 to 40. We've made 10 SARs per share. So we close out, we buy back, to close out, we buy back those shares. We buy back 100 shares at 40 SARs. This is covering our short position. We've now closed out this trade. We are no longer at risk. So what is our net return? Well, we sold at originally 5,000 and we buy back at a cost of 4,000. So we've made a profit of 1,000 SARs. Don't forget, we have to give up that dividend. All economic rights go back to the lender. So the lender, the original lender, is looking for that cash. So what you have is net profit of 750 SARs. If we put up a margin of 50% of 5,000, that's 2,500. That means we have made a 30% return. All right. Now, just to remind you, why did we put up this additional margin? Well, we didn't put up cash. And remember, cash is king. Yeah. There's no volatility to cash. There's no credit quality issues with cash. So if you put up securities of a lower quality, you're likely to have an additional margin. And that's why I've showed you this illustration here. Now, what I'd like you to think about is this little scenario here. Which of the following statements is false? I'd like to get your opinion on this, just your views which is false regarding the shorting of shares. Short selling contributes to market liquidity. Is that false? Short selling helps to check unwarranted upward price moves, and it thereby stabilizes the market. Price discovery could be significantly enhanced with the banning, the prohibition of short selling, or maybe it has been accused that short selling may result in a short selling frenzy that may contribute to market collapse. So let me just get rid of the laser and let me open that up. And what we have here is a QR code on the left. What you can do, if you wish, is get your mobile phone and take a picture, or rather put your camera above it, and then press the little yellow button, and then that will open up the Mentimeter, and that will allow you to choose one of those options. So which of the following statements is false? Which of the following is false? What I'll do to get it going is just show you, just take your camera, place it over the QR code. There's a yellow box, press that. And within seconds, something comes up. Hold on. Oh, good. Someone's done it. Excellent. Just views coming through. And if you have, for some odd reason, an issue with a QR code, I don't know if you can read this here, by all means type in menti.com, menti.com. It will then ask you for this code, and that's 68485477. So we now got a number. Oh, it's equal. It's equal again. It's moving faster than I can talk. I'll leave that open for just another 5 or 10 seconds. Okay, let's do a 5-second countdown. 5, 4, 3, 2, 1. Okay, so which of the following statements is false? Short selling contributes to market liquidity. Yes, it does. Yeah. It might be on one side, it's on the bid side rather than the offer, but certainly it does. Oops, sorry, didn't mean to press that. Short selling helps to uncheck unwarranted upward movements of price, thereby stabilizing the market. Ooh. What do we think about that? Sounds good. Price discovery could be significantly enhanced with the prohibition, the banning of short selling. Not so sure about that. We're going to come back to that to see very shortly. And D, it's been accused that short selling does or may result in a frenzy that contributes to market collapse. Well, certainly that's some of the criticisms. So that is indeed true. But I would argue that price discovery could be significantly enhanced with a prohibition is definitely not the case. So that is false. Short selling is liquidity. That's true. Short selling helps to check unwarranted upward price moves and stabilize the market. Yes. D, that's also true. That's one of the criticisms. But what I'd like to do now is let's have a 10-minute break, a coffee break. If you have any questions, please by all means put them on the chat, and I'll see you back in 10 minutes. It's approximately 5 minutes to the hour. Stretch your legs, have a coffee break, and I'll see you back at 5 minutes past the hour. Okay, welcome back. Hopefully you had 10 minutes breather, had a coffee and a stretch of legs, fresh air, whatever. Welcome back. Let's continue on our journey on short selling. And let's go one stage further. So I'm going to ask you your views on short selling. Do you think that these short sellers are destroying shareholder value? And let me just open up the Mentimeter again. All you need to do, just as a reminder, is get your camera or your mobile phone camera, place it above the QR code, press the yellow button, and it's a question of, do you agree with this statement or do you not agree? Do short sellers destroy value? Let me open up the box. And it's a poll. See what your views are. There's nothing right or nothing wrong. It's just an opinion. And we have do not agree so far in the lead. Are short sellers destroying value? Are they an evil, a curse to the markets, in other words? Or maybe you have another view, that you believe that short sellers are providing liquidity to the market. I'll leave that open for a little while longer. Okay, well, there's no right or wrong answer here. It all depends upon your own perception. But I'd like to just provide you with somebody else has agreed with that statement, I think. I'd like to just put my side, my view forward. For me, short selling is not a destroyer of value. If you go long a stock, it creates value. Short selling doesn't destroy any value. It just moves the share price. All right. There is no more price impact than any normal buy or sell transaction. A sell being that you are long the shares and you are selling. Yeah. It doesn't hurt the company from a corporate structural point of view. Yeah. So now I'm going to build on that and get you to look at this little scenario here. With your views in mind, do you believe that this practice of short selling should be banned? If you think it's an inherent evil, perhaps you'll ban it, or actually you think it adds value to the marketplace. So let me open up the Mentimeter again, and by all means, use the QR code. And again, I'll stress that if your camera doesn't pick up the QR code, here where I'm flashing the cursor, just type in menti.com, followed by these numbers here, 68485477. So that's a number of people that have come in and put no need to ban it. I'll leave that open for a while. Oh, more coming in. It looks like it's equal now, or thereabouts. I'll leave it open a little while longer. Oh, another one coming in. Ban it. Oh, dear. But it looks like the no need to ban it are in the lead. I'll give you a 10-second countdown and we'll close the poll. Five, four, three, two, one. Okay, again, let me put my perspective onto it. Of course, everyone has their own view, and you might not necessarily agree with this, but for me, one of the most important things for a developed market is to ensure liquidity. So if you ban short selling, you're taking, from my perspective, an important source of liquidity away from the marketplace. As a matter of fact, it's a safety net. If we look back to the global financial crisis of 2008, 2009, where governments and regulators around the world put a ban on short selling, certainly of government-related stocks and bonds, and indeed on financial companies. Did that stop the fall in price? No. What we saw when they banned the shorting on bank stocks, for example, share prices continued to fall, and not just by a small amount, by significant amounts. Yeah. And if you remove the ability to short, not only are you removing part of the liquidity in the marketplace, you're also removing a lot of the information that we can get that will assist us in price discovery. Yeah. So for me, from my perspective, if we were to ban short selling, it's actually unhelpful. And if we can't get the information, and the information is the flow, the liquidity, then the price isn't, from my perspective, a genuine price. What you're doing is truncating one side of the bid and offer. That bid, if you prevent that bid, the short selling, you're truncating it, and you have a skewed market, and that will affect liquidity and price discovery. Cool, thank you. So now, let's say we are looking at shorting. What are the possible screens that you would look at to identify a potential candidate for shorting? Well, we've seen this on and off over many decades. There might be occasions where you'll see a very substantial increase in a stock price. You know, you see it with particularly the tech stocks, the FANGs of this world, the Facebooks, the Amazons, the Alphabets, the Netflix, etc., the Teslas, where they might suddenly shoot up 10–20%. That might be just pure supply and demand, or indeed it could be some news. So the news factor down here, let me get the laser back up so you can see where I'm pointing to more clearly. The news factor. Also, a good candidate for shorting might be negative sentiment either on that company and or the sector. Reputational issues. We price company reputation, management reputation into the share price. And if that has a poor image, then that is a possible candidate. Also, there are times when sectors and/or stocks can go into a bubble. In other words, their valuations are overstretched. They're trading far above their intrinsic or fair value. Also, there might be insider trading. I don't mean the manipulation, I mean the true insiders. Management are selling. Now, some selling by management of the shares might be on the back of options, so stock options that they got for reaching certain targets. If they are exercising those options and then selling some of the shares to be able to pay for those options and or the tax, that is not a negative sign. But what is negative is when management starts selling the shares. That is a good screen, all right? What we will also be looking at is the data, the information, and what information particularly we're going to look at. Something that we call short interest. I would like to know at any one moment in time, what is the percentage of the company's shares that are being borrowed? And that is for the case of shorting. So I can see the amount of interest in shorting, what we call short interest. And if I look on the right-hand side, let's think not just about the screening tools, but more from the company perspective. What are the characteristics that would signal a good short from the company's perspective? Let's take a big picture. The wrong business model. If we go back, let's say, 3.5, 4 years ago, with the start of COVID, and we look at the global retail sector, those companies, those retailers who did not have the right model for that moment, they've done particularly badly. In other words, the model, is it appropriate? The model for the retailers was to have an online presence because we couldn't go to the shops. A bad business model. Weak financials. And if we look at the financial reports and we see that the share price isn't reflecting a deterioration either now or a forecast deterioration, that's a perfect characteristic to highlight a short. The quality of management, or should I say the lack of quality of the management. Management, their quality, their reputation comes with goodwill. If that management then underperform, that goodwill should be priced in, i.e. the lower price, the lack of that goodwill. Something that we're seeing now. We've been in a period of low or zero interest rates for the last 12, 15 years. And many institutions and many companies were borrowing heavily at historically low levels. So they have a high debt burden. Now interest rates have gone from a 0% environment to a 5, 6, 7% environment. And this high debt burden is burning the free cash flow of these companies. Or perhaps there are some accounting issues in the financial statements, or some creative accounting. This might be a very good characteristic trait that would signal a short sale. Now, you can do very well out of short sales, but just like a long position, if you get your direction wrong, you will lose. So let us highlight some of the risks of short selling. It's a directional trade. So remember, if you've shorted something, your expectation is the price is going to go down. You're at risk if the price goes up. So let's think about this first point here at the top. We know that we have to do a covered short. What does that mean? At execution or prior to execution, we've got to facilitate the stock borrow. If we're selling something we don't own, we have to deliver that at T+2, whatever the settlement date is. So we need to borrow that stock to cover that sale. Now, there is a liquid borrow market out there, but as you all very well know, liquidity isn't perfect, and there may be times when liquidity dries up. So it's very important not only to assess the free float of the underlying share, i.e. how many or what percentage of the shares are free to trade, and also how much is already being borrowed. Because if too much is being borrowed already to facilitate the shorts, it's likely to mean that the costs of borrowing are going to go up, right? Beware that when you are shorting something, and if the rest of the street or the rest of the marketplace is shorting as well, there might be volatility. And remember, if the price move goes against you, i.e. the share prices move up, you will need to top up your margin account. For every dollar, for every SAR that you're losing, you need to top up on a one-for-one basis. So you will need liquidity in your cash accounts to be able to facilitate that increase in margin. Also, remember, when you borrow the stock, there is typically a daily recall, i.e. the lender, who is the original owner, as we call it, the beneficial owner, can recall any day. It's all in the specified in the loan agreement. We've done the margin. Don't forget, there might be dividends that you will need to cover as well. If you've shorted, you are responsible for paying that dividend. And in theory, there's unlimited losses. So this is the asymmetric risk return profile in comparison to the long position. If I sell something at 100 SARs, the lowest it can go is to 0. But I could sell short at 100, and the share price, if I'm very unlucky, could do a Tesla, for example. In other words, go from 100 to $1,000. And this is the asymmetric risk reward profile. Now, when you short, hopefully you'll have a price target in mind. Going back to our first example, let's say we shorted an underlying share at 50 SARs. If our target, and let's say we're forecasting 35 SARs, if our target is reached, we need to close out the trade. How do you close out the trade? You sell the shares in the open market, you buy back the shares in the open market, and then you return the shares to the lender. If the price goes up, you've made a profit, but if the price goes down, you've lost. But what could possibly happen? This is what we call the short squeeze. There might be a time when you are squeezed as a short seller. This is a rush when everybody else is covering their shorts and buying back. Yeah, this is going to cause a tremendous upward momentum in the share price. The share price can possibly rocket. And I'll show you a few examples very, very shortly. And of course, remember, for each SAR, each dollar, the price goes up, and you will have to put up increasing margin. You've sold at 50. If it goes to 60, you need to put up 10 SARs for every share that you sold. That's the margin call. It's a daily margin call. So beware the volatility and a short squeeze. All right. So this short squeeze is where you are being squeezed out of your position. If everyone is borrowing the stock, there is a squeeze on the stock borrow. That fee, that rebate for borrowing can rise significantly, therefore squeezing your P&L. If the share price is rising at the same time, then you're putting up increasing margins. There's a point at which you capitulate, you give up, and you're forced, because of the losses, to close out your trade. The perfect example, if I go back to shortly after the financial crisis started, so about I think it was 4, 5, 6 weeks, my memory filters here, after the start of the financial crisis, people were shorting the automobile sector globally. And certainly in Europe, there was a massive short of Volkswagen. Yeah. And that was at a time when Porsche was thinking of trying to take over Volkswagen. Now, there was a short squeeze. In one day, while the global markets are down about 5-7%, the German market, where Volkswagen is listed, the DAX index, the German index, went up 5%. And that was literally solely attributable to the rocketing share price of Volkswagen. There was a short squeeze. Volkswagen, prior to the squeeze, was trading at around 85, 90 euros per share. As everyone scrambled to cover their short position and or buy back the stock as the price was rocketing higher and higher, the fees went considerably above 0.5%, considerably, put my teeth back in, considerably above 10, 20, 30, 50%. It skyrocketed the fees, squeezing out the shorters. The share price during that one day went from 90, let's say 90 euros, as high as well over 2,000 euros, and closed at around 1,500. So a mega squeeze on the shorters. Now, a lesson to be learned. If you are looking at doing a short sale, you've got to see how many of the shares are available to trade, i.e. what we call the free float. The big mistake that market participants made on shorting Volkswagen was that the free float for shares on VW, Volkswagen, were around only 25% of the total issuance. And why is that? Well, a large part of Volkswagen is held by a long-term holder, the state. Yeah. So that was around 27%. Also, and this is what's important, you need to get this information, not just about the free float, but also if there are any large option positions out there that are then exercisable into the shares. Because Porsche had bought around 35-40% of the company, and a lot of that was through call options, which were exercisable into the shares. So there was a very limited amount of shares to borrow in the market. So the stock lending market, they're squeezing the prices for the, or the rebates, the fees are shooting up, and they're squeezing the shorters. So, okay, we've now identified one of the risks, and this could be the short squeeze. It's very easy to identify this after the fact. It's not so easy to identify the conditions that could create a short squeeze before it occurs. However, there is some data that we can look at to help us identify this risk. Yeah. First of all, I think sentiment is one of the biggest drivers of price. So it might be a good idea to assess the sentiment of a particular stock. If we think about Tesla 5, 6, 7 years ago, it was the most shorted company. Yeah. Yet the price, and I'll show you shortly, was not being reflected potentially in the real marketplace. If everybody is shorting, why isn't the price going down? That's because there's a group of believers, let's call them believers, that look at forecasted fundamentals and are buying into that forecast, even though the rest of the market doesn't believe it. So you need to get a handle, a grip, an understanding of the bullish sentiment. We're going to think about an indicator, a very important indicator, and that is the short interest. And how much, in other words, how much of the stock is being shorted at any one moment in time. And for me, if I see a stock with a very large percentage of its shares that are being shorted, that could be a bullish indicator, and an indicator that a short squeeze is possible. So be aware of that. We're going to have a look at that with Tesla, and we'll also have a look at Coinbase in a second. Yeah. Let's think about these short interest indicators in a second. But before we do that, let's look at and try and identify some of the classical signals of a potential short squeeze. The first one, maybe a stock that's trading at its year lows, its 52-week year lows. Think about how much of the stock is already being borrowed, how the costs of that stock borrow are moving over a period of time. Look at the volumes of the shorts and the percentage of the company that's being shorted. Is the company, your target company, is it trading at a large discount? That could be a signal to short, but also tie that in with the believers, as I call them, the long holders of the stock, and other people that still believe in the future fundamentals of the company, because a large discount might very quickly be removed as the buyers come in. Always keep an eye, if you're shorting, on the financial calendar of that company, when they're likely to make a quarterly or a semi-annual trading update, because there might be positive news in there. And keep an eye on the in and outflows, particularly the institutional inflows. Are they starting to build up positions? That could be a classical sign of a short squeeze. So let's look at two metrics that can assist us in determining whether a short squeeze is a possibility. The first one is what we call short interest. It's a very simple indicator. It is the number of shares that are being shorted as a percentage of the total outstanding number of shares. The higher that percentage, one could argue, the greater the bearish sentiment on that company and on that stock price. But beware, if the short interest starts to approach 15 and 20%, that could also be a warning sign that a short squeeze could come. And it's the short squeeze that is going to hit the short seller. Another metric to look at, the short interest ratio, sometimes referred to as the number of days to cover your short position. What does that mean? Well, I want to know, if I've shorted, how many days or the time frame it's going to take for me to buy back those shares to close out my trade. And the longer it takes, the more at risk you are. Yeah. And the more pronounced a short squeeze effect can be. So let's highlight it with an example. So I'm going to go back, what's this, 3 years ago. The price chart actually goes back 5 years. So this is Tesla. In white, where I'm tracing the cursor, this is the share price. In blue, we have the short interest. That's the percentage of the shares outstanding that are being shorted. And in red, we have the number of days it takes to cover that short position. If you need to close out, you want to close out as quickly as possible. So how long is it going to take? So we can see that if we go back to 2018 and 19, which seems like many, many years ago, it's only 5 years ago though. The share price relatively flat, nothing too exciting. And what do we notice? The short interest, that's on the right-hand side, at this moment in time, around September 2019 to around March, sorry, not September, March 2019 to September 2019, we see the short interest, which is on the right-hand scale, at around, well, it's over 30% of the share capital, let's say 33%. And what do we notice? As the shorting interest increases, so does the number of days to close out that short in the open market. So short interest percentage shoots up. It's 30%. Has it had any effect so far on the share price? A very limited effect. Yeah, there are too many believers in the Tesla story. Then what do we see? We can see that the short interest, the number of shorts out there, is going down quite dramatically. And we can see along with that, the number of days to cover that short would take 7 days to cover all the shorts in the market, and it shoots down to less than, at this point here, the beginning of 2020, to less than 1 day. What's that? 0.7 of a day to cover the entire shorts in the market. But look what's happening to the price. Now, this doesn't look like a large price increase here, but it is substantial. Yeah, this is around $25 here, and it peaks here, and that is around $60, $65. So a very significant price increase. And then all of a sudden, the share price shoots down again. And that's because the remaining shorts, or more shorters coming in, they've got the timing right. But notice, Tesla is now in profit, or has increased its sales considerably over the last 3 years. And we can see now, the blue line, that the percentage of shorters out there is only 3% of the shares outstanding. From my experience, many people, or from what I gather, many people have got burnt on Tesla by shorting it. They look at the fundamentals. If we looked at the fundamentals 4 years ago, it didn't look good. It's like many a tech company. It was a dream, but a dream that could not be realized. The thing is, it wasn't a dream. And there were many believers. And a number of major hedge funds over the years have been burnt badly by not understanding that when we short, we've got to also think about the sentiment behind the company, the believers, as I like to call it. Keep an eye on that. And another example. Here is Coinbase. So Coinbase is a very large cryptocurrency exchange, or one of the larger ones. And it's obviously a relatively new company. We can see here, it's again a 5-year period. If I go, or rather, sorry, this is not a 5-year period because it was only launched in early 2021. In white, we have the share price. In blue, again, percentage of shares that are being shorted. And in red again, the number of days it takes to cover this short. Now, of course, we know that this company has a tremendous amount of debt. It's not totally, but it's highly correlated to the fortunes of Bitcoin and the trading around Bitcoin, Ether, and the other major top 10 cryptocurrencies. But then, of course, it wasn't so long ago that there was a problem in the crypto market with FTX and Alameda. And this caused the share price to fall very, very substantially, from around $200 all the way down to, let's call it, $50. The shorters did very, very well. Now, what we see after a few months after the debacle around FTX, the crypto exchange, there's now a very wide trading range. Let's say from around just over, let's call that $55 to around $100-ish. And you can see the price shooting up, the price shooting down, and tying that in with the degree, the extent of the shorting. As it hits this peak, there's more shorters coming in. It then comes down in price. People are taking their profit, and we can see that because the short interest, which is here, is around 25%, and then it drops to around 17%. So this is an example where shorting went very well. Tesla, the previous one, is an example where you can get burnt. We've got to combine the fundamental analysis with a technical analysis and overlay that with a more holistic view on the market, on the underlying. Think about the sentiment and what I refer to as the believers. And the believers won the game. Coinbase, a very different story. But this price range, this very wide range here, is a perfect opportunity or signal for shorters. If you can sell at 100 and buy it back at $55, $60, that's a wonderful price move for you. So I'd like to conclude and then open the floor to any Q&A, just with a number of points. So short selling occurs when an investor borrows a security and sells it on the open marketplace with a view that the price is going to go down and buys it back for less, hopefully. But remember, if you have shorters that are capitalizing on a decline, we've got to distinguish those shorters who are speculators from hedgers. So if we're doing our analysis on the percentage of shorters, what I would also need to think about is, are these shorters or are these long-term holders who are just putting on a hedging strategy for the short term while there's a great deal of liquidity? Short selling can be very, very successful, and it can net you some very substantial profits. But don't forget the risks, because it can also amount to very significant losses. And don't forget, in theory, those losses are unlimited. Tesla going, if we went back 7-8 years ago, from $100 to $2,000. For me, that's infinitely high. And don't forget, it's not the profit, the P&L is not just about the price difference from where you sold and where you cover. You will have to pay a fee to borrow those shares. And that fee might be 25 basis points per annum today, but because of supply and demand and sentiment in the market, that fee could rise considerably. So keep an eye on the costs of borrowing that stock. And don't forget, any cash flows that accrue from the stock, such as dividends, they will need to be paid to the lender. The lender maintains all the economic rights, and that includes the dividends. So you need to take into account, if you're crossing a dividend period while the transaction is open, then you are liable for paying those dividends. So that concludes our webinar today. I would like to thank you very much for listening, for attending. And indeed, I'd like to thank the Financial Academy and their co-partners the Stock Exchange, and the CMA for sponsoring this event. And I'm very happy to open up any questions to the floor. Otherwise, if not, I wish you a good day and many thanks. If there's a question, by all means, shout out.
Thank you very, very much, Professor. It was a pleasure having such an insightful information from you. And our viewers, they're sending out thanks and regards to you and to Jeff
Many
as well.
thanks.
And thank you very much for Zishi to present such an interesting concept. Thank you very much.
Thank you. God bless. And
All right.
have a good day.
Thank you. Bye-bye.
Thank you. Bye-bye.
Bye.